In recent years, there has been a growing interest in alternative banking models that challenge traditional banking practices. One such model is the full dollar custody banking system, which has gained popularity in Wyoming, particularly with the Custodia Bank. However, despite its potential benefits, the Federal Reserve denied Custodia Bank's application for a banking license. This decision has sparked a debate among economists, bankers, and policymakers on the viability of the full dollar custody system and the role of regulatory authorities in shaping the banking sector. To understand the controversy surrounding full dollar custody banking, it is crucial to first grasp the concept of fractional reserve banking. Fractional reserve banking is a system where banks keep only a fraction of their deposits as reserves, lending out the rest to borrowers at interest. This practice creates credit and expands the money supply, but it also exposes banks to the risk of bank runs, where depositors demand their money back at once. To mitigate this risk, central banks like the Federal Reserve require banks to maintain a certain level of reserves and oversee their lending practices. In contrast, full dollar custody banking involves holding 100% of depositors' funds in cash or government securities, ensuring that there is no risk of default or bank runs. The model is particularly appealing to savers who are risk-averse and seek a safe haven for their money. Custodia Bank, based in Wyoming, has championed this model, positioning itself as a custodian of funds rather than a lender. The bank has attracted interest from investors seeking an alternative to traditional banks, and its business model has been lauded by some economists as a solution to the inherent risks in fractional reserve banking. However, despite the potential benefits of full dollar custody banking, the Federal Reserve has denied Custodia Bank's application for a banking license. The reasons cited for the denial are unclear, but it is speculated that the Fed was concerned about the systemic risk that Custodia Bank's model could pose to the banking sector. By holding 100% of deposits in cash or government securities, Custodia Bank would not be able to create credit or lend money, which could limit its ability to support economic growth. Additionally, some policymakers are wary of the potential for full dollar custody banking to facilitate money laundering and other illegal activities. They say same thing of Bitcoin, but with no mention to all traditional banks doing money laundering. The Federal Reserve's decision has sparked a debate about the role of regulatory authorities in shaping the banking sector. Some argue that the Fed's denial of Custodia Bank's application is an example of regulatory overreach, as the bank's business model is sound and could offer a valuable alternative to traditional banks. They argue that the Fed should not be in the business of picking winners and losers in the banking sector and that market forces should determine which models are viable. Others, however, contend that the Fed's decision was the right one, given the potential risks posed by full dollar custody banking. They argue that the fractional reserve system has worked well for decades and has contributed to the stability and growth of the economy. They also point out that the Fed's role is to ensure the safety and soundness of the banking sector, and that allowing banks to hold 100% of deposits in cash or government securities could undermine the system's stability. Right now is very stable smiley face. Despite the controversy surrounding full dollar custody banking, it is clear that there is a demand for alternative banking models that challenge traditional practices. Many savers are wary of the risks inherent in fractional reserve banking, particularly after the 2008 financial crisis, and are seeking safer alternatives for their money. This demand is reflected in the popularity of Custodia Bank's model and in the rise of other alternative banking models, such as credit unions and community banks. The debate over full dollar custody banking and the Federal Reserve's denial of Custodia Bank's application highlights the tension between innovation and stability in the banking sector. Full dollar custody banking model does limit the ability of banks to create credit and expand the money supply, which could have implications for the broader economy. In the fractional reserve banking system, banks create credit by lending out a portion of deposits, which expands the money supply and fuels economic growth. In contrast, full dollar custody banks cannot lend out deposits, which limits their ability to support economic activity. This is why some policymakers are concerned about the potential impact of full dollar custody banking on economic growth and stability. Fractional reserve banking system. Banks are only required to hold a fraction of their deposit liabilities as reserves, while the remaining portion is available for lending. This means that banks have the ability to create credit and expand the money supply. Fractional reserve banking allows banks to create money out of thin air by lending out a portion of their deposits. This system has the potential to fuel economic growth by providing access to credit for individuals and businesses, but it also poses risks. Creating money out of thin air through fractional reserve banking can result in what some economists call fake or unsustainable economic growth. When banks lend out a portion of their deposits, they are effectively creating new money that did not previously exist. This can lead to an increase in spending and investment, which can stimulate economic activity in the short term. However, this growth is often fueled by debt, as the newly created money is typically lent out with interest. Over time, this can lead to a buildup of debt in the economy, as individuals and businesses borrow more and more money to fuel their consumption and investment. This debt must eventually be repaid, either through the repayment of principal and interest or through default. If the economy is not able to generate enough growth to support this debt, it can result in a financial crisis or recession. Furthermore, the inflationary pressure of the money supply growth can erode the value of the currency, causing prices to rise and reducing the purchasing power of savings. This can lead to other negative economic consequences, such as reduced investment and consumption. While fractional reserve banking has been a cornerstone of modern banking systems for many years, there is ongoing debate about its merits and drawbacks. Some economists argue that it is a necessary part of a healthy and dynamic economy, while others suggest that it can lead to instability and economic imbalances. On the other hand, full dollar custody banking holds the potential to avoid these risks by keeping all deposits in cash or government securities, without the possibility of creating money out of thin air. This is for educational purposes only and should not be taken as financial advice. The information provided is not intended to be a substitute for professional financial advice. Please consult a financial professional before making any financial decisions. Please, comment, like and subscribe. Follow us on Twitter at 4YA Freedom.